Now hear this. In our training today, we're going to cover the understanding and the basic structures of immediate annuities. And these are terminologies that a lot of people might have heard throughout their years and years of investing monies into different vehicles, tax-deferred fixed annuities, tax-deferred indexed annuities. But to me, it's about show me the money. Okay, there are actually two types of monies that are available here in the United States today. And those two types of monies have classifications. One is qualified funds, and we're going to talk about those qualified monies. By the way, those qualified monies represents about a $17 trillion marketplace in America. There's approximately $24 to $25 trillion of spendable cash in America today. And 17 trillion of those dollars are classified as qualified monies. The other type of money is non-qualified monies. And these are dollars that you've already paid taxes on. So we're going to take a look at the non-qualified monies first. This is money in your pocket. This is money that you've earned as income that you've paid taxes on. Since it's already been taxed, it's your spendable dollars and it will not be taxed again. And you are free to spend this money whenever you'd like. If invested, though, earnings are taxed. Depending upon what type of vehicle that you put it into, it could grow on a tax-deferred basis, which could allow you to have a lot more money at retirement instead of taking a simple route of putting your non-qualified funds into an account that's going to be taxed along the way. So qualified funds, which remember there's only two types of money, qualified and non-qualified. Retirement money is qualified to grow tax deferred in the tax code. These are like IRAs, SEP IRAs, KIOs, simple plans, 403Bs, 401Ks, 457 plans. They have all different kinds of names, defined contributions, defined benefits. All of these dollars, though, inside of these plans are pre-tax dollars. They can also grow tax deferred, reduces the taxpayer's reportable income, but withdrawals are considered ordinary income and are therefore fully taxable, and this is the most common retirement account is the IRAs. But let's take a look at the qualified accounts. You're going to be able to take money today and put it into a qualified account and not have to pay taxes on ordinary income on those dollars today. So you're going to get a little bit of a tax break now. But here's the problem that a lot of people don't realize, that you're getting a tax break while you're able to make money and generate income. So you have the ability to pay those taxes now, but instead it has been brainwashed into America that you need to put money into a qualified plan, get a little bitty tax break while you have the ability, but then when you need the money the most and you go to take it back out of this qualified plan, it's going to be fully taxed. And at that time, you might not have the ability to earn extra income because you might be into your retirement, but you're going to be fully taxed at whatever tax bracket. Now, a lot of other things that we're going to cover, but one thing I want to make a point on qualified plans. I'm not saying that qualified plans are good and are bad. What I am telling you that if you're going to put money away for retirement, you should always put money into a vehicle. You should pay the taxes up while you have the ability to pay the taxes so that you don't have a partner that's called Uncle Sam. And then you should allow that money to grow tax deferred, triple compounding. And you should put it into a vehicle that by law, by the IRS codes, allows you to take all of that money out income tax free forever. Doesn't that sound a lot better than taxable? Yes. And oh, by the way, inside of these qualified plans, you didn't design it. The government designed it. And when they design something, do they intentionally have your best interest in mind? No. So here's the deal, and here's how I like to educate people on a qualified plan. So, I'm going to be your business partner, okay? And business together, we're going to use all of your money. Is that okay with you? No, but she said no, but yes, because she thinks that this is going to be a great solution because she's going to get a tax break. So I'm going to be your business partner, and we're going to give you a little bit of a tax break. We're going to use all of your money inside of this business, and let's just say I'm going to give you a 25 or 30% tax break today. But I'm setting the rules. I'm going to limit to how much you can put into your business for growth. I'm going to tell you when you can take the money out, and if you take it out too soon, I'm going to penalize you. And when you do take the money out, even though I gave you a 30% tax bracket today, I'm not going to guarantee how much of that money is going to be mine when you take it out. So the day that you take it out, I can say, I want 30, I want 40, I want 50, 60, 70, 80, 90, 100% of that dollar, because I'm in control. I control the thermostat of when you take the money out and how much you're going to get. You're going to take all the risk. We're going to use all your money. I'm going to do nothing in return, but I'm going to decide how much of that account that I get. How long do you want to be in business with an individual like that? Not very long, right? But that's exactly the type of business that you're in when you set up a qualified plan. So, most common retirement accounts are IRAs. 82% of Americans over 65 years of age have a retirement account with an average of $168,000 in it that hasn't been taxed yet. There's $17 trillion in IRA accounts that have not been taxed yet. It's kind of a little bit ironic that our deficit today, if you go and look at our deficit, that we're at a $17 trillion deficit. What is the biggest bucket of money that the government's eye is on right now today? Each and every one of your qualified retirement accounts. That is the biggest bucket of money that the government can pull from to help reduce the deficit. So should you be worried? Yeah. I'd be worried. If you have the option to put your money into a tax-free forever plan, don't you think that you should at least take a look at that plan? Yeah. So today, though, we're just, I just wanted to give you a little bit of food for thought, but today we're just going to study and understand the difference between qualified plans, non-qualified plans, and the different vehicles that you can put your money into. Let's take a look at restrictions and contributions. Through various types of retirement accounts have different rules and contribution limits during their accumulation phase. However, there are certain rules that generally apply during all the distribution plans. Outside of a few exceptions, withdrawals by the owner prior to age 59 and a half could be subjected to a 10% excise tax over ordinary income. So what am I telling you? There is a rule already in place that most consumers don't even realize, that if they put their money into, and whose money was it to begin with? Your money. They put your money into this plan, and if you need to take it out prior to age 59 and a half, if you have an emergency, or you want to go do something special with that money because you've been saving it in this so-called great account that wasn't designed by you, I guarantee there's not a consumer in America that would sit down and say, I'm going to design my ultimate retirement plan. The last plan that they're going to come up with is this one. Okay? But if you take the money out too soon, prior to age 59 and a half, I'm going to not only tax you at your ordinary income, federal and state, but I'm also going to add an additional 10% tax because you took it out prior to 59 and a half. Wow. On top of that, At age 70 and a half, as the owner, we're going to make it mandatory that you start taking distributions out of this plan. Because why? Because you went into a deal on qualified plans that these rules apply. And guess what? If you take money, if you don't take the money out at age 70 and a half, we're going to penalize you 50% additional tax on what you should have taken out. Now, what kind of fair plan is that? So at age 70 and a half, whether you want the money or you don't need the money, we're going to force you to take it out. Okay? And because qualified and non-qualified plans are treated differently inside of the tax code, you will need to consider using different strategies and tools to make the most of your client's opportunity. When you sit down with the client, and this is what frustrates me more than anything else in the whole wide world, you get these famous people who get on TV and they're given all of this tax advice or all of these money retirement advice, and they're trying to stick people like me, people like you in the same category. They think that my desires and my needs are the same as yours. And they think that they might be the same as yours. So they put us in one big box. There is not one specific plan that fits all. Every single time you sit down to do a retirement plan, it should be designed specifically for you and your family's needs, not anybody else's. So where do annuities fit in? And today we're going to be talking about annuities. And over the years, the word annuity has kind of, because of a lot of these special commentators, and I don't want to list them, some of them starts with an S, some of them starts with a D, some of them starts with a bunch of loudmouth people that get on TV that get paid by these big, huge mutual fund companies to say whatever they want to say to get you to put their money in their plan, whether it's good for you or not. But annuities over the years have kind of received a bad name. And it's because of a word called variable annuities. A variable annuity is an annuity that has some protection. It can grow tax deferred, it can grow triple compounding, but it doesn't have the ability for no downside loss. And just because they associated the word a variable annuity to that plan, and that plan has the ability to lose you money, what people actually heard was the word annuity. Okay? So an annuity, by the way, is neither a qualified or a non-qualified plan. An annuity, rather, is a financial agreement issued through an insurance company. An insurance company is the same companies that we insure everything that we have in the world. We insure our homes, right? We insure our cars. We insure our lives. We insure our health. Don't you think you should insure your money? So think of it as a receptacle, a savings vehicle, or a financial tool. And an annuity allows you to work with both qualified and non-qualified plans. So if you happen to have a client who says, but Bill, I still want the tax deductions, well, let's take a look at our vehicle called a fixed or an indexed annuity, where we can get you outstanding rates of returns, but we can guarantee you no losses ever. Your account will never go backwards. There has never, ever been $1 lost to a client inside of an annuity in history. Is there any other vehicle that can say that? No, there isn't. So the money can grow, or the money can be converted into guaranteed payments. How would you like to have a plan that you can convert it when you decide into a payment stream that you can never outlive? that you know is going to be paid to you monthly, quarterly, semi-annually, or annually for the rest of your entire life, and could be over your life and your spouse's lives, no matter how long you live. And you know exactly how much that money is going to be, and it's going to be predicted, and it's going to be guaranteed. Would that give you a little bit of a peace of mind? Yep. Sure it would. So the money can either be qualified or non-qualified. So guess what? We just opened ourselves up to a $25 trillion marketplace that we can guarantee our clients a safe, predictable rate of return and a guaranteed no loss period. A famous person said one time, and a lot of you probably know who it is, I don't need to bring up the name, rule number 1, never lose money. Rule number 2, don't forget rule number 1. Okay? So, there's two types of commercial types of annuities sold. We have what's called our single premium immediate annuities, and then we have our tax deferred annuities. And an immediate annuity supplies a series of income payments at a regular interval in return of a premium or premium that's been paid into it. Immediate annuities are often bought for future retirement income because in today's society, if you received $400,000 in cash today, wouldn't it be probably a good chance that you could spend that $400,000 real quick? Okay. Wouldn't it be nicer if you had the choice to put that $400,000 into a vehicle that can grow tax deferred, triple compounded, can get incredible rates of return? We're not talking about just 1, 2, 3%. We're talking about potential 5, 6, 7, 8. And our history and track record have clients that are making 10, 12, 15, 20+% rates of return with zero downside risk. And then you decide when you want to turn it on for income, and oh, by the way, you can turn it off anytime you want, and the money is always yours. Okay? So only an immediate annuity can pay an income that can be guaranteed to last your entire lifetime. And the newer annuities today have come out with what we call lifetime income benefit riders that allow you to take full control of those annuities without annuitizing them, which means that they become irrevocable, and allows you as a client to predict exactly how much you want, when you want it, and you can stop it and start it whenever you want. And the value of the account value always belongs to you and your family, not anybody else. So, non-qualified immediate annuities, let's take a look at some of the income advantages. Payments are a blend of earned interests that are taxable, because inside of a non-qualified annuity, unless it's set up right, and we're going to talk about that later, it could be tax-free forever. How would you like to put money away into an annuity that grows triple compounding, and then when you take out the money, you get to take it all out tax-free, and you don't have to report it. There is no line item on the IRS form to report it to, and you can spend every single dollar of it, and it will not affect your tax bracket, and you will not get taxed on it. Okay? So inside of an immediate annuity is return of premium and your earned interest, which is excluded by taxes. The percentage of each payment that is actually excluded from taxes is stated by the insurance company as the exclusion ratio. As a result, only a small portion of income received from an immediate annuity is taxable income. Now, an immediate annuity might be right for an individual depending upon their needs. Once again, we're going back to that one idea or one vehicle just doesn't fit all. So we have a number of different vehicles just for, and that can be designed for your needs. So income options. Inside of an immediate annuity, you can take a lifetime income. Income payments are made for your entire life, of as long as you own it. No matter how long you live, payments will continue to come to you until you pass away. Okay? Period certain income annuities. Income payments are made for a specific number of years over that period of time. If the annuitant passes away during that period certain, then it can be continued on to the designated beneficiary, or they can take the rest of the money as a lump sum. And then we have period certain with life. This is an essential blend of the two options above. Income payments are made for a specified period of time. But if they live past that period of time, they're still going to get their payments. These are just options that are available. So inside of the new lifetime income benefit riders, we can have a guaranteed income option available without annuitizing, without losing control of the account. This allows you, as a client, the flexibility and the guaranteed income that you can never outlive, which is great. Once started, you can stop the payments and restart them whenever you want. Okay? And the guaranteed payments can never go down, but can always go up every year, and it keeps you in control. The minute that you lose control of your money, you lose control of your life. Okay? So, tax-deferred annuities. There are two types of, and that was immediate annuities. There are a lot of immediate annuities sold for specific reasons, but really the majority of annuities are sold in what we call tax-deferred annuities, fixed and indexed. An annuity that allows you the safety and security that can never lose money and can only go up. Now, do not get that confused with a variable annuity. So there are few types of deferred annuities. One's a variable annuity, and you can lose money in a variable annuity. Okay? But there are also fixed annuities and what we call fixed indexed annuities. If we take a quick look at variable annuities, and I don't want to spend a lot of time on this one because I personally don't recommend variable annuities. Basically, it's essentially a mutual fund with a tax-deferred wrapper around it. Variable annuities are designed for investors. The owner's principal is in play and at risk at all times. What does that mean? That means all of your money, you have the potential for the gains, but you also have to accept the losses. Okay? And the cash values can and do fluctuate in the annuity. They go up and they go down. And for purposes of this review, though, variable annuities will not be considered. Okay? So what we're going to focus on is fixed annuities. The greatest vehicle in the world today for accumulating wealth outside of a properly structured life insurance contract that is guaranteed not to lose money no matter how the market reacts. Inside of fixed annuity, the interest rates is stated by the insurance company every single year, so you know exactly the rate of return that you're going to get. The company generally guarantees this rate for a specified period, such as 1 year, but you can go 5 years, you can go more for a guaranteed rate. At the end of the interest period, the company will state a new interest rate. The initial rates in some contracts may be higher than it will be later. This is often called a bonus rate. Each fixed annuity also has a minimum guaranteed rate of return. And this is kind of what I call sleep insurance on your money. Every night when you go to sleep, I guarantee that you will be a little bit richer when you wake up in the morning. Okay? So let's take a look at our fixed annuity safety tree here, or our pyramid. Annuity assets are fully protected by the insurance companies against loss. And a lot of people don't understand, if an insurance company is good enough to protect your family, your health, your life, your car, it better be good enough to protect your money. Okay? Also, credited interest is also protected. Once it's given to you, it cannot be taken back away. And annuities are safe and totally guaranteed No savings vehicle exceeds the safety of fixed annuities anywhere in the entire world. Okay? So if we're going to look at the high risk to the low risk, future options, top of the chart, stock market, small cap funds, large cap funds, mutual funds, junk bonds. The middle, lower risk, investment grade bonds, government bonds, real estates. And then we have the lowest risk of all, CDs, money markets, savings accounts, and fixed and indexed annuities. Now, just because it's down here with CDs, money markets, savings accounts, fixed annuities, and indexed annuities doesn't mean because it's the lowest risk that you're going to, normally what you're going to think, well, if it's the lowest risk, I'm going to get what? The lowest rate of return. Well, not today. Through indexing, we can absolutely get high rates of return. We can get double-digit rates of return. We can get stock market type gains with zero downside risk. And we're also going to give you an underlying guarantee. When we link these index annuities to, say, the S&P 500, your money's really not going into the S&P 500 index. It's just mirroring the performance of the index. But when that index goes up, you're going to get a percentage of that gain. You might not get all the gain. But in return, when that index goes down, when every single American in the country is inside that index losing spendable dollars, we guarantee you no loss. So your account balance will never go backwards. Is that not a great return? Yes. Think about all of the people that were inside of an account that did not have an underlying guarantee of safety, of loss. And all of a sudden they woke up one day, which has happened many a times over the last decade, and their account balance might have been $500,000, and they woke up and the market dropped so fast that it was worth $200,000. When they needed the money the most that day, they only had $200,000 to access. Every single client that was in this vehicle, that same $500,000, the market just crashed, that very same client, because they accepted no loss guaranteed in the contract, still had $500,000 if they needed the money that day when they needed it the most. So where do you want to put yourself at? Do you want to put yourself in the position of every time oil prices goes up, my money could drop? Every time the government decides to think about doing something, doesn't it affect our stock market and our rates of return? It is an uncontrolled environment by you, which puts you totally out of control. You need to always stay in control of your money, and you need to always know exactly where you stand at all times. And this is exactly what puts you in control of your money. So let's take a look at fixed index annuity, one of the greatest retirement vehicles in America. I will go head to head against any other type of mutual fund or stock, because I can always say that my clients or clients that are inside fixed and indexed annuities have never lost a dollar. I don't know of one mutual fund company, stock, mutual fund, anywhere in the world that can say they've never lost a dollar to a client. I'd like to see one. If there's one out there, I'd like to be informed about it, because I've never found one. And we're not talking about some mutual fund company who wakes up tomorrow and says, oh, I had this mutual fund and we have 15% rate of return last year, Bill, but we've only had it in force for a year. This is decades of zero loss to the clients. Okay, a fixed annuity, a fixed indexed annuity is just basically a fixed annuity. It gives you all the safety and security and guarantees, but the credited rates of return are not determined by the insurance company's portfolios. They're determined by an outside index like the S&P 500, the Dow Jones, the Hang Seng. There's so many of them. And so it it is mirrored to those indexes where your money's not directly in the market, but you can get a percentage of the gain with no downside loss. Okay? So when an individual buys an index annuity, they own an insurance contract again, and I'm not afraid to say that my money is in an insurance contract. I have so much life insurance that are cash accumulation values that have the ability to grow tax deferred, triple compounding, and I can take my money out tax free. And I'm not afraid to say it because it's one of the last great tax-free vehicles left in America. There's only 3 of them that I know of. Muni bonds, okay, which that's nothing to write home about, okay. Roth IRAs done properly inside of a fixed or an indexed annuity, and a properly funded life insurance contract. And those are the real, only true, last tax-free retirement vehicles. It's not about the rate of return that you get. You can be the greatest person in the world and get the greatest rate of return. But what are you going to be remembered by when your family? Let's say that you turned $100,000 into $1 million, and you just bragged about it every single day, right? And you tell your kids, look at me, look what your dad has done. I'm teaching you. I just grew 100,000 to $1 million, but then dad passes away. And depending upon what state you might be in and the vehicle that you're in, if it doesn't have the protection of annuity, might have to go through what we call a probate process. Might not be protected by creditors like this one is. And all of a sudden, after all the smoke and dust clears and all the expenses are done and all the taxes are done, your family ends up with $150,000 or $200,000. Doesn't make the father so great anymore, does it? So a fixed annuity contract is different. An indexed annuity contract is different from a fixed annuity because of the way that the interest credited to your annuity values are credited. Indexed annuity credited here, fixed indexed annuity credits interest using a formula based on changes in the index, which is annuities, which is linked to the annuity. Okay? The formula decides how the additional interest, if any, is calculated and credited. How much additional interest gets credited and when it gets credited depends on the features of the particular annuity. So like a traditional annuity, the fixed annuity offers guarantees. Okay? In addition to a minimum guaranteed value, the fixed annuity generally offers a guarantee of principal and past credited gains that can never be taken away. Note, not all indexed annuities provide guarantees of past credited interest rates, so you need to make sure that the annuity that you're wanting to utilize for your client meets their specific needs. So let's look at the appeal. The primary appeal of an indexed annuity is safety and security. The ultimate goal for an indexed annuity is to create the potential to exceed traditional fixed interest rates without exposing principal and or path growth rates to market risk. Non-qualified annuities have an advantage inside of a tax-deferred annuity. Why? Because according to the IRS Code Section 72, inside the code, you will find that an annuity is intended by the federal government to be used as a retirement vehicle. And it's written right in the code. Barring a few exceptions, an annuity owner accessing their tax-deferred accumulation before achieving 59.5 can also expect to pay the 10% penalty tax unless it's set up properly, and then we can potentially avoid that tax. Okay? This rule was created according to the tax facts to discourage the use of annuity contract as a short-term vehicle. Annuities are created for long-term retirement goals and income streams. So, let's take a look at non-qualifieds. Has an advantage inside of tax-deferred annuities. Advantage number 1, there's no contribution limits. Inside of a qualified plan, you might be limited to how much you can put into it. If I tell you that you can only put $6,000 a year into your plan, but you want to put 12, did I just limit you to the ability of putting more money into your plan? Well, inside of these plans, there's no contribution limits. You can put as much as you want into them. There's no required minimum distribution. When you hit 70 and a half, we're not going to force you to take your money out. Leaves you in what? Leaves you in control. You should be the one who decides when, if ever, that you're going to take your money out. So let's take a look at some tax-deferred advantages. One of the greatest features of an annuity is it's called tax deferral. And all this means is that your money earning on an annuity are not taxed until the money is withdrawn. Okay? So not only do you earn interest on your principal, which we'll call simple interest, you earn interest on your interest, which we call compounding interest, and you earn interest on the taxes that you would have otherwise paid to Uncle Sam, which overall we call this triple compounding. And because of the triple compounding method, this allows you to grow your money faster. The brown or the goldish bar represents a taxable account at 6%. The light green bar represents a tax-deferred account at 6%, and the dark green bar represents a tax-deferred account even after taxes. So if you put them side by side and someone says, you need to put your money into an account that's going to be taxed along the way, you're losing the power of that deferral to grow your money faster. So over a 5-year period of time, and let's take a $50,000 initial payment into your, let's just say that a client says, I want to put $50,000 into this vehicle. And they're going to get and we're going to make it a fair playing field, and they're going to get a 6% rate of return. And we're going to put them at a modest 28% individual tax bracket. Is that fair? 5 years. The account value inside of the taxable account that is earning interest now for the next year is only $61,000. Inside of the tax deferred account, it's $66,000 earning interest on that 6%. Now, if my account in the taxable account $61,000 and it's earning 6%, am I earning less money than the account that's in $66,000? $66,000 times 6% is going to create more interest in my account than $61,000 times 6%. Even after I take taxes out in 5 years, I am still ahead of the game. And every single dollar counts. So let's take a look. That was at 5 years, now at 30 years. In 30 years, the $50,000 and you didn't put any more money into it. But if you have to pay taxes along the way, your value is going to be $177,000, earning interest for that next year at 6%. Compared to, it could have been $287,000 earning interest at 6%. And even if you took all of the money out and paid that 28% tax bracket, you still end up with a whopping $220,000, over $40,000 more, because you allowed the compounding method to take effect of your money and grow your money faster. It's all smart money management. And who was in control at all times? You were. You were in control at all times, and you were taking advantage of our tax codes and the ability to grow your money faster for the benefit of you and your family. That's the key that everybody else seems to forget about. So, the annuity advantage, say you are saving money, your intention is to use from your savings to generate income when you retire. Okay, so in this scenario, you have $50,000 to invest, and now let's say that you're at a 33% combined tax bracket and could earn 3% interest in either a fixed annuity or a CD. Well, someone today might say, Wow, a 3% CD rate. I don't even know if I've seen a 3% CD rate. But there used to be 3% CD rates. In the late 80s, there were CD rates that were really high, wasn't there? So here's an example of future interest that you would receive if you were deferred the taxes or paid the taxes while you was growing your money. So this is just another example. And here's what I like about these types of scenarios. And we kind of hit on some of these topics earlier. It's not a pie in the sky. Here's one thing I learned real fast, and one thing that everybody should understand. Math and numbers don't lie. People might lie, but numbers don't lie. Okay? So let's take a look at that same $50,000 inside of our annuity value at 5 years. It's $57,963. Next year, annuity interest that would be credited to that account at the modest 3% rate, we're not even talking about 6 anymore, we're just talking about a modest 3, is $1,738. But inside of your certificate of deposit, which is a CD, which I also call certificates of depreciation, okay, your account value is $55,231. That next year's CD interest rate after taxes is $1,110. Just on a short 5-year period of time, the annuity advantage alone is $628 more a year. Now, it doesn't sound like a lot of money, but $628 more a year can go a long ways, because that $628 you just didn't give up because you are now more educated on how it actually works. But let's take a look at 30 years into the future. We could take a look at 10, 15, 20, but let's take a look at 20 years. Your annuity value is now $90,000, earning 3%, and I'm giving it once again a modest rate. It could be a lot higher, but we're just going to be super ultra conservative. That's $2,700 that's credited to your account, compared to the CD value that's only valued at $74,000. And do you really think that when you give a bank your money and they put it into the vault that it just stays there and collects dust? No. They take that money and they do what with your money? They invest it and make a whole bunch of money. So why don't you put your money where it's financially benefiting you more than it's benefiting them? So here your CD value is $74,443. Your next CD rate's going to be $1,496. That's a $1,200 a year just at 3% difference that's being credited to your bottom line. Okay? So other benefits of tax deferral, we may reduce taxes on Social Security benefits. As a Social Security recipient in America, the average Social Security recipient receives $900 to $1,200 a month in Social Security benefits. They might not even have any other retirement plans. How in the world do you live in the state of any state off of $900 to $1,200 a month? On top of that, the government has said, we're going to tax your Social Security benefits. Didn't we pay taxes to get the benefit? And now we're going to be taxed on our Social Security again? And we're going to cover that in a few minutes. Did you realize that you can either get a 0 tax on your Social Security or a 50% tax on your Social Security, or as high as 85% tax on your Social Security benefits? And you know what? It's determined by how successful or how much money you earn every year. You're going to be penalized on monies that you paid taxes on to have a benefit every single year you put away if you make too much money when you retire to get the money that is rightfully yours in Social Security. You're going to be penalized for making too much money, so they're going to tax you because of that. So this is due to something called provisional income. Provisional income is used to calculate the taxes paid on Social Security benefits and includes items like normal earned income from CDs, as well as 1/2 of your Social Security benefits is received as a tax-exempt income from muni bonds and from muni bonds. So nothing, when we talk about provisional income, and this is a whole topic all by itself, there's no vehicle out there that excludes your provisional income vehicle that determines whether you're going to be taxed on your Social Security, except a properly funded Roth IRA, and if you utilize it inside of a fixed or an indexed annuity properly, and a properly funded life insurance contract utilized for the cash value buildup. Everything else falls and determines the value of that tax that's going to be on your Social Security. We just right there wiped out the whole entire industry. Everybody in the world should be putting their money in these vehicles just to save from being paid taxes on that. So let's take a look at it. Did you know as much as 85% of your Social Security benefits can be subject to income tax? 85%. So if you're a single individual, and these are your provisional income levels, and you're making between $25,000 to $34,000 at retirement, and half of that money is included in your Social Security. So let's say that you are receiving $1,000 a month, $12,000 a year, right? Automatically add $6,000 onto that number. So if you add $6,000 onto that number, you can only make $19,000 more from other retirement vehicles before we're going to hit you with the tax. That's not very much money if you're living anywhere in the United States. So as a single taxpayer, if you exceed the $25,000 to $34,000, your Social Security benefits are going to be subject to an additional 50% tax. That's huge. But if you go over that $34,001, it's not 50% anymore, it's 85%. Okay? If you're married, filing jointly, and I haven't figured this out, you're married, so we're going to double whammy you. You're married, we're going to take both of your combined incomes, and we're only going to move it to $32,000. Well, if there's two people and they're making it $25,000 on one, shouldn't it be $50,000 if you're married? But they're actually reducing it. So if you're married filing jointly and you make above $32,000, between 32 and 44, your Social Security is going to be subject to up to 50% additional tax. Over 44,000, they didn't even give us any breathing room here. 85% tax. Provisional income includes the total amount of normal earned income like interest from CDs, as well as 1/2 of your Social Security, and tax-exempt income such as interest earned from your tax-free. Someone once said, well, muni bonds are not included as provisional income. Oh, yes, it is. Everything is included as provisional income except properly funded Roth IRAs and properly funded life insurance contracts. So, now let's take a look at liquidity and access to your annuities. While the primary focus of an annuity is to defer it for accumulation and then a continued income stream that you can never outlive, you always stay in control of your money. Over the years, the experienced annuity companies have become well aware of the client's need to access money from time to time. So what we've added in there is annual penalty-free withdrawals. Okay? Example, 10% free each year after 1 year, and some companies can go from 10%, and if you don't use it, next year you can take 20. Some companies, if you don't use it after 2 years, it allows you 30%. There are some vehicles out there that even allow you more liquidity and access to your money. We give you systematic monthly income that you can never outlive, loan provisions, and when we talk about surrender charges, This is an area that most licensed representatives in the United States like to avoid, is the contract term, surrender charge. Because what does automatically a client or an agent think? It's a negative. Well, generally surrender charges come into play when withdrawals requested from an annuity exceeds a penalty-free amount. But here's another way I want to define contract terms and surrender charges. A contract term to me is a benefit as a client on my side, because whatever in that contract, guaranteed safety of my money, stock market type gains with no downside risk if I'm in the index side, protection from creditors in most states, avoid probate. Don't I want that contract? Isn't that more beneficial for me? All of those contract terms benefits me and the value to my family more than it benefits the insurance company. So, surrender charges are normally expressed as a percentage. Usually they get smaller each year until they ultimately vanish altogether. And after surrender charge periods has expired, 100% of the value of the contract is available at no charge. So let me give you a look at liquidity and surrender charge, and you tell me whether or not this is reasonable. First off, a surrender charge is not a fee. A fee is something that a mutual fund company or other firms will take a percentage of your total account value out. They will put it into their pocket for profits, whether your account value makes money or loses money. And they will do that year after year after year. And I get really tired of the individuals who get up and say you should never buy something that has a contract term and a surrender charge. You should come and do it with me because we're only going to charge you a fee. And let's say that we charge you a fee of 2% a year, and over the next 30 years, that 2% is going to hit your account value every single year over the next 30 years. Do you realize that you could pay hundreds of thousands of dollars in just fees alone? Wouldn't you be better off to know exactly where you stand all the time with your money? So let's take a look at, I'm going to give you some real life examples. Here's a $100,000 annuity. No fees. Contract term and surrender charge. And I'm going to give this contract a 10% penalty-free withdrawal. And I'm going to give it an 11% surrender charge. Now somebody might jump up and say 11% is a lot. No, it is not. The annuity is not designed for you to put money in and take it out whenever you want and go spend it because you're thinking about buying a boat tomorrow. Go put that under your mattress or go put that in the bank. Okay? An annuity is designed for a retirement vehicle. Okay? So here, we're going to show the withdrawal percentage amount. We're going to show the penalty-free withdrawal. And I'm just using a 10% penalty-free withdrawal because I'm going to make a really strong point. The amount exposed to surrender charge, the actual surrender charge amount, and the surrender charge amount as a percentage of the account value. Now let's say that we put $100,000 into this account and we're not even showing the credited rate of return. It could get 3%, it could get 5%, depending upon where you index it to, it could get even more, correct? Okay, but I'm not even going to show a rate of return. We put $100,000 in. Next year your client says, I need $10,000. They can take that $10,000 out. The amount exposed to surrender charge is 0. The actual surrender charge, even at 11%, is 0. And the surrender charge amount as a percentage of the account value is 0. That's a pretty darn good deal. Now let's just play a reversal. I put this $100,000 into a mutual fund. And once again, I'm not going to give it any credited rate of return. But they're going to take out that, let's say, 2.5% and put it into their pocket. So they just took out $2,500 of your money. And you still needed the same 10%, right? and you still took out or still needed the same $10,000. You take that $10,000 out, but they've already taken their $2,500 out. It's a big difference when you start looking at it at a different light and a different angle. Let's get a little bit more aggressive. Let's say that for whatever reason, and once again, we're not even going to show an interest credited rate of return. You need $20,000, 20% of your account value out. So 10% of it comes out what? $10,000 comes out penalty free. The other 10% is exposed to the surrender charge. And here, I'm giving you an 11% surrender charge. That's $1,100 is exposed to a surrender charge. When you break it out, that's only 1.1% of your total account value. And remember, we didn't take out any fees. At an average 2.5% fee account, I'm already still ahead of the game. Let's even make it a even worse case scenario. For whatever reason, your client needed, because an unexpected emergency arose, and they needed $40,000 out of their $100,000. The first $10,000 comes out is penalty free. That leaves $30,000 being subjected to the surrender charge. That's only $3,300. That's only 3.3% of the total account value, and that's in case of an extreme emergency. Do you think you could pay that surrender charge of 3.3% if you needed the money the most? Sure you can. So what is the approximate amount of money to place into these contracts? It depends on the consumer's intention to use the money. If they did not expect to use it, they still have access to it. Annuities are always liquid, and that's another point that a lot of people think, that once you put your money into an annuity, you can't ever access it again. That's not true. So, riders and waivers, there's additional liquidity that's built into annuities or increased access without penalty. So if I'm confined to a nursing home facility, a hospice, if I have critical illness, terminal illness, I can access all or most of my money at no surrender charge. That's huge. Years pass, and all of a sudden, 4 or 5 years from now, I have a terminal illness, or I'm confined to a nursing home or a convalescent facility for 90 or more days, whatever it might be, and I can access all of my money and my interest credited gains with no surrender charge. That's a benefit for me. But I put this money in a mutual fund, years pass, and they take out 2.5% every single year. 5 years have passed, they take out 15 or 20,000. Do I get to go back to them and say, oh, by the way, can I have that $20,000 because I became sick or I became terminally ill back? No, you lost it forever. So future income needs. According to the National Association for the Insurance Commission, annuities are the most often bought for future retirement income. While the majority of insurance companies report that an extremely small percentage of annuity owners ever convert their policies to income, it is anticipated that the demand to turn your money into an income stream that you can never outlive is going to continue to rise, and that's what we're seeing today. That's why with the design of the new annuities with the lifetime income benefit riders are the most popular annuities probably purchased in today's market. Most deferred annuities allow for cash values to be converted to a specific annuity payout called annuitization. In general, this will give the owners access to the income options discussed earlier in the immediate annuity section of this report. So tax advantage distribution. Like an immediate annuity, annuitization payments may form a previous tax-deferred non-qualified annuity or a blend of interest and premium, which is excluded from taxes. Anytime you can exclude money from taxes, you should take advantage of it. Okay? However, due to the tax-deferred buildup within the annuities, you can expect a larger percentage of each payment to be taxable. Death benefits. This is another myth about annuities. It's because a tax-deferred annuity offers a death benefit to the designated beneficiaries. When you place down your beneficiaries on that line, your wife, your husband, your children, your grandchildren, if something happens to you, the money will immediately pass to them. It's not going to go through a probate process if you have probate in most states. It's not going to be accessible by creditors. It's immediately going to go to the people who deserve the money that you designed it, because you're no longer here to fight for that money to make sure it goes to them. Okay? Not all death benefits are the same. The following, though, on the annuities we use, because not all annuities are the same, like the variable, but full accumulated value. The benefit waives all surrender charge. So when do a surrender charge ever come into effect? They primarily never come into effect unless you have some type of emergency need for the money that you expected that you was going to save up for retirement. So if you died early, you get all of your account value and there are no surrender charges. Okay? So the benefit waives all surrender charges and pays the full value of all of your gains also to your beneficiaries. And you can also take out a 5-year payment. This benefit can be found on a small percentage of tax-deferred annuities. This benefit specifies that upon death, the annuity will pay a designated beneficiary for the value over a 5-year period of time, in case they might want their family to have the money spread over multiple years. So additional benefits, because an annuity is a contract with an insurance company, a properly designated beneficiary may avoid the costs and delays of probate. Tax rules. Because a tax-deferred annuity receives its tax benefits through the Internal Revenue Code, insurers must comply with certain death benefit rules. Generally, the entire value of the contract must be distributed within 5 years of the owner's death. Well, most people want the money immediately, and that's what the annuity also allows. So let's look at some other tax rules. Spousal continuation. If a designated beneficiary is a surviving spouse of the owner, they may elect to assume the position of the owner of the annuitant and keep the annuity in place and keep it growing for tax-deferred purposes and income purposes. At the death of the spousal's beneficiary who has assumed the position, the contract would then pay to the new designated beneficiaries according to the normal identified rules. That would be the children or the grandchildren. The last designated beneficiary you want on any of your accounts is the U.S. government, because they'll be able to spend your money, and that's not a bad thing to say. You want your money to go to either your family or to your charities of choice. You don't want somebody else to determine where your money goes when you're no longer here. So eliminate any confusion. In addition to explaining surrender charge as mentioned earlier, you must be sure to address the most common complaint levied on fixed annuities after the sale. And here are the top complaints. And we're going to address them. Fixed annuities. Products with an enhanced first-year rate. Indexed annuities. Complaints often orbit around unrealistic yields, expectations, or confusion about crediting strategies and how it works. So make sure that when you sit down with a client, you show them the product history of the rate of returns so that they know what to expect. Okay? And you don't have to oversell indexed annuities. You don't have to go out and tell every single client you're going to get double-digit rates of return, because that's more than likely unrealistic. But you can tell the clients that you're going to get a specified percentage of the rate of return and you're guaranteed no loss. And that is realistic. Okay? So eliminate the confusion, the maturity dates. Consumer and regulators alike often misunderstand the annuity maturity dates. A maturity date, a deferred annuity They have an issue date when the contract begins and a maturity date. And the maturity date is the longest a consumer may keep the deferred annuity, and it's at not a limit or when they can get them to their money like they might think, but a maturity date is basically saying, I'll give you an example, 110. If you live to 110, we're just giving you all of your money and all the interest credited gains back. Okay? That's all the maturity date actually is. It does not affect or limit the client's liquidity provisions at all. Maturity dates are confused because people think, wow, that maturity date says 90, 95, 100, 110, whatever it is, they think that that's when they can get to their money. That is absolutely not true. Okay, it's just confusion. Remember though, accessing funds is controlled through penalty-free withdrawals that puts your clients in control. They know exactly where they stand at all times, and which is important. Most companies set maturity dates far beyond the duration of surrender charges. Okay? So it's literally years and years. I mean, most of them are in their 80s, 90s. The new ones are 100, 120-year-old maturity dates. So immediate annuities are utilized for what? Income. But no longer today do you have to really worry about immediate annuities, because we have the indexed annuities that have the income riders on them that you can stop and start them, so you don't have to worry about utilizing immediate annuities as much. But there are reasons why you're going to utilize immediate annuities. Payments are guaranteed, just like on the income riders, which makes them a very safe planning tool, and they can be structured in a variety of ways. A lifetime income you can never outlive, a period certain with life. Non-qualified funds receive tax-deferred distributions, but I personally like the income rider annuities. I like to have the guarantee of the income for life, but I can stop it and start it whenever I want. So summary again, tax-deferred fixed annuities and tax-deferred indexed annuities is guaranteed safe money. I would rather be able to get the return on my dollar guaranteed than a maybe it might be there. Can you tell me exactly, to the exact penny, if I buy this home for $500,000 today, exactly how much that home's going to be worth 10 years from now when I need the money the most? No. Absolutely not. Can you guarantee me, if I buy a mutual fund today or a specific stock, the exact value of that stock 5 or 10 years from today? No. Inside of these vehicles, we can tell you almost to the precise penny what the value is going to be, guaranteed. And it's safe and secure. The primary difference between fixed and indexed annuities is the way that the companies credit the interest rates. A fixed annuity is credited and is stated every year from the insurance company. An indexed annuity earns interest and provides benefits that are linked to an external equity index like the S&P 500. Well, somebody once came up to me, which happens a lot, and they said, well, I was told by Joe Schmo or Mrs. Schmo on these fancy-dancy news stations that I should diversify my money. Don't put all my eggs in one basket. Well, let's see. If I'm getting 100% safety and security of my money, and I'm linking my money to the S&P 500 index where my money's not really in the market, but it's mirroring the market, and I get a percentage of the gains and no losses, isn't the S&P 500 index about 500 of some of the best companies in the entire United States, maybe around the world? Isn't that true diversification? Absolutely. So, to properly understand and present a fixed or an indexed annuity, you should have detailed knowledge of the following. What is the rating of the insurance company? What is the minimum and maximum issue ages of a plan? And most of our issue ages of plans go all the way up to 80, 85, 90 years old. Are the issue ages different for qualified and non-qualified monies? The answer is going to be yes. Does the plan allow flexible premiums or a single premium? We allow both, depending upon the plan. It can be flexible or single. And what is the minimum and maximum premium amount allowed to go into the product? And what is the minimum guaranteed rate of return, no matter how everything else is affected? What is the minimum guaranteed rate of return that that account's going to receive every single day for the rest of its life, as long as it's in there? Okay? To properly understand and present, what is the interest crediting methods, fixed or indexed? What is the withdrawal provisions, monthly, penalty-free, semi-annually, annually? All of those are available. What is the annuitization and future income provisions? Are there waiver provisions? That would be like the confinement waiver, the terminal illness waiver, the loan provisions. Those are all in there. And how is the death benefit structured? Is it full accumulation value, or is it a payout? And if you do it right, you always would like to make sure the full accumulation value goes to the beneficiary. No surrender charge. Even if they died the very next day, or after the first year, even if we credited them 10% and they died, if it's a vested crediting, they get that full value and it goes to their beneficiaries. And then, of course, what are the surrender charges to make sure they fit in line and that your clients understand it? Don't ever sit down with a client and avoid contract terms and surrender charges, because they are more valuable for the client than what most people actually think. Okay? Suitability. Equipped with this knowledge of what we kind of gone over, and there's a lot more that we're going to train and educate on, you'll be better prepared to serve your clients. Ultimately, the goal should be to recommend products and solutions that are suitable for each individual client. Once again, no one product fits all. That's why we have a number of different products that can be designed for their need. Something to consider before recommending an annuity: the client's current financial situation. Don't take a client's dollar if they plan on, if that dollar's not allocated for a retirement goal and they plan on spending it tomorrow. An annuity is not the place for it. Matter of fact, almost no vehicle is a place for it. Maybe in a bank account, maybe under their mattress or somewhere, but that is not recommended for an annuity. An annuity is designed for retirement. Take the client's tax status into consideration. The client's personal goals and objectives into consideration. The client's risk tolerance in consideration. If a client sits down and says, I am tired of losing money, I want to put my money in an absolute safe vehicle with no risk, period, and I want it there when I need it the most, and I want it to go to my family, and I want zero risk, an annuity is probably the best solution, bar none, against any other vehicle out there. And be sure to consider other information that the clients provide to you that could affect the outcome of their decision. For more information or support, contact our office here right away. And thank you.